now. So now that you know what is meant by international tax, now let me tell you what are the branches of international tax. And what I'll do is I'll not simply write second part is branches of international tax, branches of international tax. Instead of simply writing branches of international tax, what I'll do is I'll give you a little bit of flavor of these two branches so that you understand what exactly is international tax all about. Fine, a little flavor of just a bit of teeny bit of taste. So there are two branches of international tax. The first branch is tax treaties, and the second branch would be transfer pricing. Transfer pricing, right? Tax treaties, and the second branch is transfer pricing. Tax treaties are also known as DTAAs, that is Double Taxation Avoidance Agreements, Double Taxation Avoidance Agreements, or DTCs, that is Double Taxation Conventions. And by the very name you would understand that their objective is to prevent double taxation. Fine. Let's focus upon tax treaties first, and the second branch, transfer pricing, we'll visit this area after we are through with this, right? So tax treaties, the first branch of international tax. Tax treaties, yes. Okay, so tax treaties. Fine, tax treaties. What exactly are tax treaties? Tax treaties, in very simple terms, they are agreements, they are bilateral agreements, conventions, bilateral agreements between two countries. Bilateral agreement, obviously they are bilateral, so they have to be between two countries. So bilateral agreements between two states in the sense countries. Those states which enter into a tax treaty, these two states are known as contracting states. So tax treaties are bilateral agreements between two contracting states. What is the objective of entering into a tax treaty? There are two major objectives. In fact, the first major objective of a tax treaty is to prevent double taxation of income, and the second objective is to prevent double non-taxation. First objective, preventing double taxation, and the second objective is preventing double non-taxation. Double non-taxation, yes. And believe me, in the past several years, to begin with, this was the major objective, preventing the double taxation of income, because this was an impediment for the conduct of international trade between countries. But then gradually this has acquired a greater significance, preventing of double non-taxation of income, preventing of tax evasion, because double non-taxation leads to tax evasion, tax avoidance, tax fraud. Therefore this objective is equally important, preventing of double taxation as well as preventing of double non-taxation. These are the two primary objectives of any tax treaty. There are other ancillary objectives as well: facilitate information exchange, facilitate dispute resolution in the area of tax disputes, facilitating assistance in the collection of taxes. But then they are ancillary or subsidiary secondary objectives. These are the two major objectives, and I'll give you one example how does double taxation of income occurs. Fine. Okay, see, so what do you have? Let us take, we have two countries. Let us take an example wherein we have two countries. country R and country S, right? And in country R we have a company. That company is named as RCO. Co is company, fine. We have a company in R and this company is incorporated and or it has a place of management headquartered in R. So therefore this RCO, this company which is a legal person, this is a tax resident of country R. So this is a resident. This is a tax resident of country R. Fine. Okay. R and S at this point of time, they don't have a tax treaty between them. They don't have a tax treaty. Fine. Okay. So RCO conducts business operations in R as well as in other countries as well. Globalized world. World is a village. So RCO company conducts business operations in S. So RCO conducts business operations in S by an extension, by its extension. This extension is being shown by a dotted line. Why by a dotted line? Because this extension, which is known as, which is a branch of RCO, it is not legally a different person. It is not legally a distinct entity. So that is why it is an extension. RCO is shown by a firm line because it's a legal entity, but this extension is shown by a dotted line because it's not a legally distinct entity, it's not incorporated, it is simply an extension. So this extension of RCO into S, by which RCO conducts business operations in S, this is the branch, and in the international tax terminology, this branch, when certain conditions are satisfied, this branch is known as a permanent establishment. So this is PE. PE stands for very, very important concept, permanent establishment. Permanent establishment. Fine. So let us assume that this RCO has a PE in country S and business is being conducted in country S by this branch. So by the conduct of business, supposing this PE earns what? This PE earns, say for example, this PE earns $100 of profit. $100 of profit. Okay, this PE earns $100 of profit by the business, by virtue of business, and the tax rate, the effective tax rate in country S, ETR, effective tax rate, the effective tax rate in country S, ETR, effective tax rate in country S, say for example is what, 30%. So you apply 30% tax on this $100 of income. This is the net profit. Fine. Assume this is the net profit. So you apply 30%. So therefore, tax in country S is equal to how much? This is equal to $30. Now, why would S tax this 100? S would say that this 100 is, I'm taxing this 100 because this 100 is being earned in my territory, in my country. So this is the source jurisdiction. Source jurisdiction, that is, S says that this $100 of income is being sourced from my country. Fine. So that is why I'm going to tax this 100. So after taxing, $30 is the tax which is collected by the state S. Okay, fine. Now, what would R say? The country R would say, okay, fine. I'm not concerned about this tax which RCO has paid in country S. I am going to tax this $100 of income as well, because ultimately what happens? Remember, see, this was simply an extension of RCO. This is not legally a different entity. So for all practical purposes, which is true in reality, this is just one entity. This is RCO. So ultimately what would happen in the books of RCO? This $100 enters and reaches this country R. So now it's very, very natural, because RCO is the tax resident of R. So R would tax this 100. Forget about this. R is not concerned about this. R says that my tax resident, my resident company has earned $100 of income. I'm going to tax. So supposing the tax rate in the ETR in state R is say 40%. So 40% of this 100 is what? Tax in R is 40. So R collects 40 on this 100, on this 100. S also collects 30 on this 100. So therefore the total tax paid, how much? The total tax paid, total tax is 1 plus 2. So $70 is the total tax paid, and what is left in the hands of ARCO is left only with $30 of income. So net profit, that is after tax. This is the example of double taxation. Double taxation, the same income, this $100 of income is getting taxed twice by two sovereign authorities, that is tax authority of S as well as tax authority of R, leading to only a very small amount post tax. This is known as double taxation, and again in the international tax terminology, this is a classic case which is known as juridical double taxation, or international juridical double taxation, or simply double taxation. This happens when there is no tax treaty between R and S. So naturally this is not a very favorable, this is not a very desirable or a favorable scenario for the businesses. Businesses have been complaining about this sort of situation for the last 100 years or even more. So therefore international tax, that is the first branch, that is the branch of tax treaties that focuses majorly upon preventing of this sort of scenario, that is preventing of double taxation. How it is done? R and S therefore would enter into a tax treaty. They would enter into a tax treaty, and by virtue of that tax treaty, coming to the entire conclusion, what would happen? S would tax this 100. S would tax this 100 by virtue of tax treaties article 7. I'm simply saying by virtue of article 7, S would tax this $100 of income, fine, and then R will not tax. So therefore this would be taken care of. This would be taken care of. R would not tax and only S would tax. This can be one of the options. Other option can be R also taxes this income like in this case, but then R provides a double taxation relief. So for example, S taxes $30 is paid in S, R taxes $40 is collected by R, and then R provides a double taxation relief. Double taxation relief, there are many ways by which double taxation relief can be provided. One of the ways can be R simply says, okay fine, ARCO, what is the amount of tax that you've already paid in country S? ARCO say that I have already paid $30. So therefore R would say, okay, that from my tax 40 I will subtract 30, I will deduct 30, so therefore I will collect only 10. Fine. So therefore the net amount of tax in that case, when there is a tax treaty between R and S, the net amount of tax would be what? $30 paid in S and then $10 paid in R. So therefore the total amount of tax would be 30 plus 10, 40. This is the first branch of international tax treaties, and mind you, this is not even the tip of the iceberg. There are many more examples, many complications, but then this is one of the major problems which is taken care of by the first branch of international tax, that is tax treaty. I hope it would be clear to you.